The fatal mistake, waiting for Monday. You think you've got until Monday morning to make your move on silver? Think again. While you're at home, cozy on the couch, the Asian markets are about to open. And when they do, everything you thought you knew about silver prices will be shattered. Oil prices are climbing, geopolitical tensions are skyrocketing, and China is getting ready to strike. But you'll be asleep while the market moves without you. The dip you've been waiting for, it's already gone. Silver just broke $80, and by the time you wake up, it might be too late. Are you prepared for what happens next? Welcome to our channel. Now that you're awake to the reality of what's unfolding, make sure you hit that subscribe button right now. Don't wait for tomorrow, because tomorrow could be too late. And hey, where are you watching this from? Drop a comment below and let me know. Let's see if you're ready to face the market before it faces you. The world of silver has always been complex, often shaped by economic forces that are not immediately visible to the average investor. But in 2026, the landscape of the silver market is changing in ways that could have profound effects on how investors perceive the metal and its value. One of the biggest shifts currently underway is the growing influence of Asia in setting the global price of silver. For years, investors in the West have been accustomed to seeing silver prices determined by trading on exchanges like COMEX in New York. However, this is no longer the case. As silver continues to rise in value, particularly after breaking the $80 mark on Friday, the market is experiencing a structural shift that requires close attention. While the Western markets are still operating under the assumptions of the old order, Asia has emerged as a dominant player. The markets in China, particularly the Shanghai Gold Exchange, are not just participants in global silver trading, they are now driving forces. This shift is not just a minor detail, it's a fundamental change in how silver, and perhaps other precious metals, will be priced moving forward. Understanding Asia's growing influence. The first major change in the silver market is Asia's growing dominance in physical silver demand. China, in particular, has become the world's largest consumer of silver, driven by both industrial uses, such as electronics and solar panels, and its government's strategic efforts to build reserves of the precious metal. For years, China has been quietly accumulating silver as part of a broader strategy to move away from reliance on the US dollar and the global financial system that is increasingly seen as unstable. The silver demand in Asia, especially China, is only expected to rise, further shifting the balance of power in global silver markets. Unlike the West, where silver is often treated as a financial asset or investment, Asia views silver as both a strategic asset and an industrial commodity. This has created a demand-supply imbalance that is placing significant pressure on the global silver market. As demand for physical silver surges in Asia, a divergence has occurred between the paper silver market, the futures and ETF markets, and the physical silver market, the actual metal being traded. While the futures market, based in the West, sets the quoted silver price, the actual price that buyers in Asia are willing to pay for physical delivery is often much higher. This premium pricing for physical silver in Asia is one of the key factors behind the current market shift. Investors in the West are still relying on the paper price of silver, often quoted on COMEX, but Asian buyers are paying much more for physical silver. The premiums for physical silver in Shanghai and Hong Kong have been growing steadily, reaching levels of 10% to 20% above the spot price quoted in Western markets. This isn't just a temporary anomaly, it's a reflection of a deeper shift in how silver is valued globally. The Asian market's response to geopolitical events. The second factor driving the silver market shift is geopolitical tensions, particularly in the Middle East. As the US and Iran edge closer to direct military conflict, the threat to oil supplies has become undeniable. The Strait of Hormuz, through which a significant portion of global oil flows, has become a potential flashpoint for geopolitical conflict. When the price of oil skyrockets due to supply disruptions, investors turn to precious metals like silver as a hedge against the increasing risk of inflation and economic instability. For investors in Asia, the idea of waiting for Monday's market open to make a move is no longer viable. Asian institutional investors, particularly those involved in the Shanghai Gold Exchange, are operating in a completely different time zone, both literally and figuratively. When the markets open in Shanghai on Sunday night, Eastern Time, the price of silver will have already been influenced by decisions made by institutional buyers in Asia. These buyers will not wait for the West to react. They are already anticipating the market assess response to any escalation in the Middle East and are positioned to buy silver aggressively. This is why timing is so critical. As soon as a geopolitical risk surfaces, particularly one that threatens oil supplies, Asian buyers move quickly to secure their physical assets. By the time investors in the US wake up on Monday morning, the price of silver could already have moved substantially in one direction. This is the gap-up phenomenon, a price surge that occurs when the market opens in Asia, leaving behind a trail of investors scrambling to catch up. The disconnect between paper and physical silver. Another critical factor in understanding this market shift is the disconnect between paper silver, futures contracts, ETFs, and other financial instruments, and the actual physical metal. The paper market, where contracts for silver are bought and sold, operates on a fractional reserve system. In theory, the amount of silver represented by paper contracts is much greater than the physical silver that exists in vaults. This has been the norm in the silver market for decades. Paper silver trading is often seen as more liquid and less constrained by physical availability. However, as demand for physical silver rises in Asia, this system is coming under pressure. Physical delivery is becoming more difficult to fulfill as inventories in Western vaults shrink and premiums rise in Asia. When geopolitical events increase uncertainty, buyers in Asia know that securing physical silver is more important than holding paper contracts, which are backed by a promise of metal that may not be there when delivery is required. As Asian demand continues to surge, the paper market will find it increasingly difficult to meet delivery demands, leading to price increases that reflect the true scarcity of physical metal. This is why the Sunday night open in Asia is so critical. It's not just about the timing of when markets open. It's about the market dynamics that are in play during Asian trading hours. As geopolitical events unfold and physical silver becomes harder to obtain, the price disparity between the paper market and the physical market will widen. Those who are not positioned in the physical market ahead of these events will find themselves chasing prices as they rise. Conclusion: understanding the shift in global silver markets. The silver market is no longer solely influenced by Western trading hours or the familiar mechanics of the New York Stock Exchange. Asia, particularly China, has become the driving force behind global silver pricing. As geopolitical risks rise and physical silver becomes increasingly scarce, investors in the West must adjust to a new reality. The Sunday night market open in Asia will determine where silver prices go, and if they're not ready, they'll miss out. For anyone looking to take advantage of this market shift, understanding these dynamics and positioning oneself accordingly is crucial. The window of opportunity for buying silver at favorable prices is shrinking, and as Asia's dominance grows, those who are still looking for dips may find that they've already missed the best entry point. The question now isn't whether silver will rise, it's when and by how much, and whether investors are positioned to benefit from this new reality. In the world of commodities, silver has long been a barometer for both economic stability and geopolitical tension. But what's happening now is unlike anything the market has faced in years. Geopolitical risks, particularly the rising tensions between the United States and Iran, are beginning to fuel a massive shift in the silver market, and at more risk one that could reshape the price of silver in ways that few could have predicted. Imagine this. The market is already on edge, with silver closing above $80 per ounce just before a weekend filled with uncertainty. Why is this significant? Because the stage is set for a geopolitical crisis that could send silver prices skyrocketing. The Strait of Hormuz, one of the world's most crucial oil trade routes, is hanging in the balance. A potential blockade or disruption could send oil prices soaring, and when oil rises, so does silver. While you're comfortably tucked in bed, the Asian markets will be wide awake, already adjusting to the shockwaves from the geopolitical storm. Investors in Asia, particularly institutional buyers, have long known that geopolitical turmoil is silver's best friend. As oil prices surge and inflation fears rise, silver becomes an essential hedge against instability. This is a scenario that plays out not in the distant future, but right now, today, as tensions grow between the U.S. and Iran. The price of silver is primed for a violent spike. The Middle East, a powder keg ready to explode. The tension between the U.S. and Iran is no longer just theoretical. It's edging closer to the brink of military conflict. This is no ordinary geopolitical risk. It is one that directly impacts oil supplies in the most critical way possible. The Strait of Hormuz, a choke point through which nearly a third of the world's oil supply flows, is now at the center of this growing crisis. If Iran and the U.S. clash and the strait is blocked, oil prices could skyrocket to $200 per barrel, a level that would send shockwaves through global markets. But the ripple effect doesn't stop at oil. Silver, traditionally viewed as a safe haven asset, is directly impacted by these kinds of crises. The link between oil prices and precious metals like silver is well established. When oil prices soar, inflation expectations rise, and investors flee to tangible assets like gold and silver, assets that hold value when paper currencies are losing their purchasing power. And here's where it gets interesting. Asia knows this, and they're already acting on it. While you're still sipping your coffee on Monday morning, the Asian markets will have already reacted to the geopolitical risks and the rising oil prices. Asian institutional investors, particularly in China and Japan, have long understood that silver is not just a commodity, but a strategic asset in times of global instability. When tensions in the Middle East rise, they don't wait, they move quickly. By the time Western markets open, silver will already be in the process of a violent price surge, fueled by institutional buying in Asia. Front-running the West. Why Asia is always first to act. If you're still thinking that the U.S. markets will have time to adjust to these developments, think again. Asia doesn't wait for Wall Street. When geopolitical risks surge, Asian institutional investors are already ahead of the game, while American traders are still digesting news and figuring out their next moves. The Asian markets will be executing billions of dollars in silver trades. Why? Because Asia understands that the opportunity to secure physical silver at lower prices is quickly disappearing. By the time the West wakes up on Monday, Asia will have already taken the first wave of buying, pushing silver prices up. The gap up in prices is inevitable. What does this mean for investors in the U.S.? It means that while they're waking up to the news and deciding whether to buy, they're already priced out of the market. The silver they hope to buy at $80 will already be trading closer to $93 or higher, and the opportunity will have passed them by. This isn't just speculation, it's how the market works. When the world's largest buyers see geopolitical risk on the horizon, they act immediately. They front-run the market, making their moves before the retail crowd realizes what's happening. By the time the U.S. opens its markets, silver will already be priced higher based on Asia's rapid buying, and retail investors will be scrambling to catch up. The premiums. A clear signal of what's to come. What's even more revealing is the growing premium for physical silver in Asia. Right now, buyers in Shanghai and Hong Kong are paying as much as 15% to 20% above the paper price of silver. This isn't just a fluctuation. This is a significant premium that shows just how disconnected the physical silver market has become from the paper market. Why is this happening? Because the Asian markets, particularly China, have figured something out that many in the West have ignored. The paper silver market is a fiction. The paper contracts traded on COMEX and other Western exchanges do not represent the actual physical silver available in the market. And as the demand for physical silver increases, the premiums rise. These premiums are the market's way of telling you that there is not enough physical silver to meet the growing demand. What does this mean for the silver market going forward? It means that physical silver is becoming a scarce commodity. As premiums continue to rise, the gap between the paper price and the physical price will only widen, and this disconnect will drive silver prices higher. In the coming days, as geopolitical tensions continue to mount, that premium could rise even further, pushing silver prices past levels many believed were impossible. What's coming next? A global silver price shock. As the situation escalates in the Middle East, silver will become more than just a safe haven asset. It will become a strategic tool for institutions and governments looking to protect their wealth from a collapsing global financial system. Investors in the West will be left scrambling to catch up with Asia's moves, which will already have driven prices higher. The window of opportunity is closing fast, and the Sunday night open in Shanghai is where the market will start to price in the risk. The geopolitical crisis is already underway, and by the time the Western markets open on Monday, silver will be trading at a level much higher than where it closed on Friday. The question is, are you prepared to act in time, or will you be left chasing the market as it runs away from you? The silver market is in the middle of a massive shift, and those who recognize it early will be positioned to benefit. The geopolitical risks are just beginning, and the time to act is before Asia's markets open on Sunday night. For those who wait, the price of silver will already be higher, and the opportunity will be lost. Timing matters more than ever. Will you be ready for what's coming, or will you be asleep while the real action unfolds? The next few days will determine the future of silver prices, and your ability to capitalize on them. Silver's rise to $80 was just the beginning. The true shift in the market is happening quietly in the East, and the Sunday night open in Shanghai will be the key moment when it all comes to a head. As geopolitical risks surge and the physical silver market tightens, one thing is becoming crystal clear. The real price of silver is no longer set in the West. In the world of commodities, few things are as important as physical delivery. Silver AS' unique role as both a financial asset and an industrial metal means that its value is driven not just by speculation or financial engineering, but by real-world demand. For years, Western investors have relied on the COMEX futures market to determine the price of silver, but that market is becoming increasingly irrelevant as the physical market in Asia takes over. Shanghai, the new epicenter of silver pricing. It's Sunday night, and while you're unwinding after your weekend, the Shanghai Gold Exchange is already gearing up to open. By the time you check your phone Monday morning, the price of silver will have already moved. It's not just a matter of market fluctuations. It is a matter of geopolitical events triggering massive shifts in physical silver demand, and Asia is at the center of it all. In Shanghai, investors are paying massive premiums for physical silver. It is no longer just a small spread between paper contracts and actual metal. It owns a full-scale bidding war. Premiums of 15-20% above COMEX prices are not anomalies anymore. They're becoming the norm. Why? Because Asia knows something the West doesn't. When geopolitical risks spike, the price of silver is no longer determined by paper contracts or futures trading. It's determined by how much physical metal is available and how quickly it can be delivered. This is what happens when the market disconnects between physical and paper prices. While the West continues to trade paper silver, Asia is hoarding the actual metal. And when physical demand surges, as it's doing now due to rising geopolitical tensions, the premium on silver in Asia becomes a clear signal that the paper price in the West is about to become irrelevant. The physical shortage, a silver crisis, waiting to happen. What's happening in Shanghai is a direct reflection of a physical shortage in the silver market. For months, premiums in Asia have been expanding as buyers are becoming increasingly desperate to secure actual silver before it disappears. Silver is not just an investment anymore, it's a strategic asset. In a market where supply is constrained and demand is rising, these premiums are not just signals of price movement, they are warnings. Asia is already moving massive amounts of capital into silver, knowing that the availability of physical silver is becoming more uncertain by the day. As mining production stagnates and recycling can't keep up with industrial demand, Asia is positioning itself to secure silver at any price. By the time the West realizes what's happening, it will already be too late. But the question remains, how much longer can the West ignore this shift? The Shanghai Futures Exchange, the gateway to price discovery. It's not just about the Shanghai Gold Exchange. The Shanghai Futures Exchange is a key player in this new silver pricing regime. When this exchange opens, the price of silver is going to respond to a different set of dynamics than the West is accustomed to. In Asia, silver is viewed through the lens of physical availability and strategic importance, not just as a financial asset to trade. As tensions rise in the Middle East and the possibility of oil disruptions becomes more probable, Asia's market is already reacting. Institutional investors in Shanghai and Hong Kong are moving capital into silver at a pace that is unmatched in the West. These institutions understand the real risk. When oil prices surge and inflation expectations rise, silver becomes a hedge against currency collapse and instability. And as Asia's growing demand for physical silver intersects with this geopolitical uncertainty, silver's price is primed to spike. As these markets open on Sunday night, the movement will be swift. And the price of silver will gap up. The paper silver market in the West will have no choice but to adjust to the physical market S demand. By the time U.S. investors wake up on Monday, they will be faced with a price far higher than what they expected, and it will be too late to capitalize on it. Why Western investors are getting left behind? The real shock in the silver market is that Western investors who still think of silver as a financial asset are being left behind. The Western financial system, with its reliance on paper contracts and futures trading, is not prepared for what's happening in Asia. The Shanghai Gold Exchange and the Shanghai Futures Exchange are not waiting for the Western markets to react. They are acting now, and that action will be felt in the silver price by the time Monday morning rolls around. Silver ES price in the West has been artificially suppressed for years through the use of paper contracts. The fractional reserve system used in the futures market allows financial institutions to sell far more silver than actually exists in the market. But as the demand for physical silver grows, this system is under strain. Asia's growing demand for the metal is exposing the weakness of the paper system, and silver's real value is starting to emerge. As the price gap widens between paper silver and physical silver, the market will become increasingly volatile. Western investors who are still focused on paper prices will find themselves priced out of the market as Asia ES institutional investors continue to push the price higher. The gap-up phenomenon that happens when the Asian markets open is just the beginning. The real question is how high silver will rise once the disconnect between paper and physical prices becomes too large to ignore. The future of silver, Asia's hold on the market. Asia is not just changing the way silver is priced, it's reshaping the entire global silver market. The shift from the West to the East as the primary driver of silver pricing is already underway, and by the time the West realizes the change, it will be too late to act. The real question now is not whether silver prices will rise, but how high they will go, and how quickly. For anyone looking to understand where silver is heading in the next few months, look east. Asia's dominance in the physical silver market is a trend that is only going to intensify, and with it, the pressure on paper, silver markets in the West. The Sunday night open in Shanghai will be the first indication of what's to come, but it won't be the last. The silver market is entering a new era, and the time to get positioned is now, before the price gaps up and leaves everyone else behind. The silver market is teetering on the edge of a monumental shift, but the real question is, who will control the market when the dust settles? The answer is becoming clearer by the day. It needs the institutions that understand the true dynamics of the market. As the silver market faces increasing pressure from both geopolitical forces and supply shortages, the battle for control is becoming a high-stakes game. At the center of this storm is the disconnect between paper and physical silver. For years, institutional players in the West, particularly those operating in the futures markets, have held significant influence over silver prices. This power has been based on paper contracts, a system that allows investors to trade silver without ever taking physical delivery. It's a system built on leverage, short positions, and speculation. But as the physical silver market comes under strain, this paper system is facing an existential crisis. Institutional players like major banks and hedge funds have long relied on the paper silver market to set prices. These players are accustomed to using futures contracts to gain exposure to silver, but the rise in physical silver demand is starting to unravel this system. As premiums for physical silver soar in Asia, these institutional players find themselves trapped in a market that is no longer driven by the forces they once controlled. The collapse of the paper market. The concept of the paper-silver market is simple. Institutions sell more contracts than there is physical metal to back them. In theory, this works fine as long as buyers never ask for delivery. But when geopolitical crises and supply shortages push demand for physical silver to record levels, the system starts to crack. The true cost of silver is no longer determined by the paper contracts traded on COMEX. The true cost is now being set by the actual delivery of physical silver, a process that can be manipulated by paper trades. As Asia's demand continues to surge, the premium for physical silver grows, signaling that paper prices are increasingly irrelevant. And as this shift continues, a dangerous game is unfolding. Institutional buyers who have relied on the paper market for years are now scrambling to secure actual physical silver before it becomes too expensive, or worse, completely unavailable. When major players like JP Morgan reclassified 13 million ounces of silver from registered to eligible status, it was a wake-up call that the physical market was beginning to tighten. This move essentially removed millions of ounces from the registered inventory, limiting the silver available for delivery. The stakes are higher than ever. The paper market is facing an existential threat. What happens when physical silver becomes too valuable to be controlled by paper contracts? Institutional buying spree, Asia's front-running advantage. It is not just about the disconnect between paper and physical silver. It is about what is happening now. As geopolitical risks increase and supply chains tighten, institutional investors, particularly in Asia, are positioning themselves for the inevitable. They see the writing on the wall. The silver market is undergoing a fundamental shift. China, Japan, and other Asian nations are already moving billions into precious metals, knowing that silver is one of the few assets that can withstand the shocks of an unstable global financial system. This shift is happening right now. While Western investors are still debating the merits of silver as an investment, Asia's largest institutional buyers are already in action. Sovereign wealth funds, central banks, and private investors are all buying physical silver, and they are not doing so at the paper market price. They are front-running the West, purchasing silver at massive premiums, to ensure they get their hands on the metal before the price skyrockets beyond reach. The premiums in Shanghai are already at historic levels, with some buyers paying 20% above the paper price to secure physical delivery. This isn't just a temporary anomaly. It sends a clear signal that the demand for physical silver has far outstripped the paper market's ability to supply it. The tipping point, paper contracts, collide with physical demand. At this moment, the silver market is at a tipping point. The paper market, built on leverage and speculation, has been unable to keep pace with the growing demand for physical silver. As the geopolitical climate grows more unstable and supply chains become more constrained, the paper market is in danger of collapsing under its own weight. The gap between the paper price and the physical price is growing wider, and institutional buyers in Asia are positioning themselves to capitalize on this growing disconnect. What happens when a market that has been manipulated for years through paper contracts is finally forced to face the real supply-demand imbalance? The result will be chaos. The paper-silver market will no longer be able to suppress the true value of the metal, and prices will surge as the physical premium takes over. As the gap widens between futures prices and physical prices, the system will eventually collapse, and silver will be priced according to physical availability, not paper promises. The coming crisis, physical shortages, and the death of the paper system. The writing is on the wall. Silver is no longer just an investment, it's a lifeline in a world where the global monetary system is under threat. The geopolitical tensions involving the US and Iran, the escalating oil crisis, and the growing demand for physical silver in Asia are all signals that the current financial system is broken. The paper contracts that have long defined silver pricing are losing their relevance, and soon they will be replaced by a market driven entirely by physical scarcity. As the physical silver market tightens, and as institutions in Asia continue to front-run the West, the price of silver will continue to climb, fast and relentlessly. The question is no longer whether silver will rise, but how quickly and how high. The paper market, which has been the cornerstone of silver trading for decades, will become irrelevant as physical demand overwhelms the ability of futures markets to keep up. In the coming weeks, we will see the collapse of the paper system, and silver will finally be priced according to the real-world availability of the metal. Those who are not positioned ahead of this shift will find themselves locked out of the market as prices surge past levels they thought were unthinkable. The silver market is entering a new era, and the question now is, are you positioned to ride the wave, or are you still clinging to outdated systems that no longer function in today's volatile world? The final phase of this shift is already underway. The future of silver is being written in Asia, and for those who fail to see the writing on the wall, the cost will be steep. The real price of silver is coming, and it's not a price you want to miss.